Hey there, welcome. Today we're going to be doing a presentation on indicators for you guys, specifically MACD. So my name is Brandon Gum. I'm going to be teaching this session. We're going to start off this presentation reviewing some basics of technical analysis, and then we're going to get into MACD and how to use it with a better edge than traditional wisdom teaches us. Look in the description below for time slot details. We are going to start off with a quick review of everything, so stay tuned. I encourage you to put this on a faster speed than I'm recording it at, but stay with us and we'll try to teach you some good things. Okay, so last time we looked at support and resistance, channels. We also looked at chart formations, things like wedges, triangles, consolidation. This time we're going to be looking at MACD, which is an indicator, and in the future we'll cover RSI as well as some candle patterns. Remember last time we talked about how 90% of retail traders fail. They never make any money. They quit. In order for us to actually make money in the market, we need to have an edge in order to be consistently profitable. When you're able to add an edge to your trading, that's when you can actually make some money. That's when you can actually be consistently profitable and be successful at trading. Some of you who know me know that I specialize in breakout trades. I may not be the best trader, but I'm up and coming, and I have several. I've made dozens of great trades in the past, so I am experienced enough to be able to teach a lesson on some of the things we're going to be talking about today. But really what this slide, I really wanted to focus on this slide is if you want to be any good at trading, you have to practice. Trading is not a get-rich-quick scheme. I always remind people of that, even people that are in their, have 2 years underneath their belt. It's not a get-rich-quick scheme. It's a study and then get-rich kind of deal. So let's quickly review material from last class. I'm going to try to keep this to roughly 8, 9, 10 minutes or less. Last time we discussed that moving averages are one of the most basic forms of technical analysis. Traders often buy when the faster moving average crosses the slower one, and conversely sell. So for example here, we would have bought, here we would have sold. Moving averages, they simply average the price over the last n periods. So there's a recap on that. We also said that moving averages can serve as a form of dynamic support and resistance. Some traders like to use this, not all do. Common average periods are the 21, 50, 100, and 200 period. Here we have the 50 EMA. EMA means exponential moving average, so there's simple moving average and exponential moving average. And notice how here every single time the price kind of comes down to that 50 EMA, more or less we kind of catch support off of it and we move higher. So maybe traders might be looking to add to a position here or enter a new position on the retest of that line. Along with other things, like they may use candle patterns to give them a heightened edge as well. Over here, 20 EMA, they may be using this as support and resistance to add and initiate new positions. So here's a real-world example for you guys. This is actually, today is November 16th, 2017. This is a trade I recently took. Right down here we have these two moving averages. One of them is the EMA, one of them is the SMA, and I saw a candle pattern here, a pin bar type candle pattern along with divergence, and we'll cover that in future lessons on some of the indicators down here. So I entered in my trade here. It kind of came down, dipped, touched that 200 EMA, caught support, and we moved higher. Additionally, here is one on ConocoPhillips. We're looking at the monthly chart here. The last one was on the daily. Notice here how the 200 SMA, we bounced off of that perfectly with a pin bar pattern, pin bar candle, and we moved higher. And you notice that this is from 27 all the way up to 60. So this is more than double return over a few years. I'll take that kind of trade any day of the week. Also, last time we quickly discuss support. Remember, support's the idea of demand overcoming supply. Down here, buyers are stepping in, preventing from sellers from taking it lower. The demand is overcoming the selling pressure of sellers down in this area. Remember, for support, you need roughly 3 points of contact in order for it to be a true support line. Anytime you have 2 points of contact and you're calling that a support line, you are biasing yourself. Why is that? It's because any 2 points of contact on a chart automatically line up. That's just the way things work, you know. Any 2 points automatically form a line. So we need at least 3 points of contact. Traditionally, support is horizontal. However, here you can see we're using a trend line as support here. Notice here we're actually using the 15 EMA. MA is moving averages, if you didn't catch that earlier. We're actually using the MA is acting as support along the way here. And then here, it's then acting as resistance. Kind of interesting, right? Resistance, I just discussed it a second ago, briefly, but resistance is when supply overcomes demand. So there's a supply of sellers up here that are willing to sell at $75. Now, buyers are unable to overcome the selling pressure at these points, and because of that, we move lower. Remember, we need 3 points of contact. Now, let's kind of combine support and resistance. Remember this, old resistance can become new support. And that's kind of what we see here. We have a support and resistance channel kind of forming here. We're finally able to break above resistance. And then that previous resistance now becomes new support. Pretty nice, right? Again, same thing here. Resistance, support. We break below that support. That old support now becomes new resistance. Then we break above, and now see we have that test right there, and it acts that old support became resistance, now becoming support again. Same thing here. Channels, we discussed when you have a support and resistance and it's trading in between those, we can define that as a channel. I personally don't really trade channels. I don't really draw them on my chart too much either. And when I do, I'm not trying to really trade them. I generally try to look for resistance breakouts. But this is defined as a channel, and you know, when you're first starting trading, always look for this kind of stuff. Okay, let's go on to trend lines now. So we're looking at upward trend lines to start with. Really focus on this bullet point right here. Really focus on it. When we draw trend lines, we connect the lows. Don't be the guy that draws lines on the tops. That just doesn't work, and I'll describe what I mean in a second. Notice how I have two different charts here. Both are the same company. This one is the arithmetic scale. You can look at the y-axis here. This is what your 99% of charts that you look at on a daily basis are on an arithmetic scale. I actually chart on a log scale, and I highly recommend it. And you can see why. Look here, when we have it on a log scale, my trend line is able to connect the lows. Remember, we said on upward trend lines we connect the lows. I connect the lows. 3 points of contact. Remember, with trend lines and support and resistance lines, we always need 3 points of contact. Notice how when we have it on the log scale, everything matches up beautifully. Over here, though, the exact same chart, exact same time frame, you can see that if we try to draw a trend line, it does not match up beautifully, despite it being the exact same chart, but the scaling is different. Look at the y-axis. So, but what I'm trying to cover is upward trend lines. Again, we connect the lows. We connect the lows. I'm connecting the lows. I'm not trying to connect the peaks here. That just doesn't work. It doesn't make any sense. Why does it not make any sense? Just think about it. We're going in an upward range. I'm unlike, if I try to draw a trend line, you know, connecting these peaks right here, you know, how helpful is it drawing these trend lines in this area right here until it breaks out? It's not that helpful until it breaks out. That probably didn't make the most sense. Apologies. But what I'm trying to get at is connect the lows. Just trust me here. Look it up. Connect the lows. Here's a real-world example using log channels. We just talked about trend lines, support, and resistance. Here is a trade a buddy of mine recently took. We're looking at the monthly chart here. Again, logarithmic scaling. You can kind of see it's logarithmic here. And notice if I draw a channel from this point to this point, just counting this as whatever, clearly we have point of contact, point of contact, point of contact, point of contact, point of contact. This is just a 50 line, a 50% line in between the two. It doesn't actually mean that much. But notice down here, he took an entry right down here, and bing bada boom, from about $11 all the way up to, potentially $20. That's a massive return. And we're doing this on a monthly chart using log scaling and channels. Things work out beautifully when you scale them logarithmically. If you had done this without log, it would not have worked. Kind of running out of time here. I see we're at 10 minutes, so just stick with me here. Downward trend lines. Remember, we connect the highs on downward trend lines. Again, don't be the guy that does this wrong. We connect the highs, not the lows. The only time you connect the lows is if it's an upward trend line. Here we look at the logarithmic scale. Both of them are the same. Notice how beautifully it works out when we have it in a log scale. In an arithmetic scale, we have to draw two different trend lines for it to make any sense. Again, this is why I stress log scaling. The best guys out there, when they're looking at, this is on the weekly chart, the best guys out there know to use log scaling in my opinion. So again, connect the highs. Okay, let's review a little bit. Trend lines don't always have to be, at steep angles. For example, here, notice we seem to have some sort of resistance here. The resistance is not horizontal. Notice the blue line. Now, additionally, they've also drawn a gray line here. And this gray line you can think of as a secondary resistance line. You clearly recognize that it's seeing resistance up here, but that gray line may not be the most significant. Thus, I'm going to color it gray. It's a little bit lighter color, but the blue really emphasizes that the blue is probably the more primary trend line. Notice here, again, look, it's on logarithmic scaling. Look how beautifully it works out. I might use this trend line, after 2 tests or 3 tests. On the 4th test here, I might add to my position. I might initiate a new position. Third, after I've seen it test it here a few times, on the third position, on the third point of contact or rough point of contact, we may enter our position. Quick point of notes, when we're looking at support and resistance and trend lines, it's not always an exact number. It sometimes is an area, maybe give or take, 1 or 2%. So, you may say, hey, Brandon, I don't think this is a trend line just because it doesn't touch this line perfectly. And I would say to you is, again, it's not always the exact number. It's a area. So, give or take a few percentage, I would say yes, it did come and slightly retest that trend line and then it moved higher. So let's combine everything we just talked about. We got upward trend lines. We got a high, a low, a higher high, and a higher low, right? Higher low. The last low is right here, so this is a higher low. Then we go into a downtrend. And then when we break it downtrend, we can do one of two things. Either we break it downtrend and we rally up very strong, or we break a downtrend and we trade in a sideways range, and that's what we're doing right here. Over here we have on logarithmic scaling again. I really love the log stuff. We have a nice trend line here. We have some support and resistance right here. Notice we had an all-time high at this point right here. You might draw a line saying, hey, if we break this all-time high, maybe we're going to move higher. We do move higher after we break it. We come back down. We test that previous all-time high. And then again, we come back down and we test it here. Now, when could I have initiated a position in this? Maybe on the 3rd retest, you would have initiated. On the 4th retest of the primary trend line, maybe you would have initiated a position. Also, you have this support and resistance line right here, so you would have said, hey, this is the previous all-time high. We might bounce again if we test that previous all-time high level. So let's take a look at a real-world example here. Here we have a resistance line in the form of a trend line, so to speak. And just looking at this black line right here, you might say, hey, if we can break above this black line, maybe this thing has some volume, maybe this thing has some potential. And we move higher. We'll discuss kind of some of this stuff later on in the video potentially. We're not focusing on RSI today. We're going to be focused on MACD, but this is just a quick example of how you might use support and resistance and trend lines. Here's another one. Here we actually have a chart formation of a wedge. This is something that we'll discuss here in just a second. Notice how we break this all-time high and we move higher. Notice how we break this this wedge right here and we move higher. And this is just an idea of a setup. You know, a trader might see this wedge right here and say, hey, I'm going to initiate on this break right here. And then once we start to approach this last all-time high, I'm going to add if we break out, and I'm going to reduce if we don't break out. So maybe I get in right here. I see that we're breaking, but then we start to break down. So I might take my gains in here, but once we break it back above that all-time high, bam, I'm back into the trade potentially. So this is just an example of setups, right? We like to use setups as traders. And I may have lost some of you with my context here. Just stay with me. We'll keep going, and we'll try to teach you what we can. Here's another great example of a setup. We have a flat top breakout here with some sort of triangle wedge here. Notice that we have a rising trend line here, and we have a clear resistance right here. You know, comes up, gets rejected, comes up, gets rejected, rejected, and it's narrowing oscillations here, right? When we got rejected the first time, we pulled back a lot. When we got rejected the second time, we didn't pull back as much. Got rejected a third time, didn't pull back hardly at all, and then we break out. So let's just recap a little bit. If you want to be good at trading, it takes time and practice. I really stress the importance of a trading journal. I think trading journals are very important. I use one all the time. Always record your opinions. An opinion does not mean a position. So if you see something and you think that you have an opinion about it, but you're not sure, go ahead and record it. Where do I record that stuff at? I record it in my trading journal. And so I actually use OneNote. I'll show you that here in just a second. I use OneNote, and I'll take screenshots of charts that I think I have an opinion on and come back a few weeks later and see how they did. I really stress this: quit gambling. Quit gambling. A lot of the newer traders, younger traders, they're willing to gamble their money. They know that they may be wrong, but screw it, I'm going to put all of my money into this one trade that's a penny stock because they have earnings the next day. Good luck. You have no trading edge there. What we're trying to teach you here is it's all about defining your edge as a trader. How can I put the odds on my side? How can I trade like a professional, right? Professionals out there, you like Warren Buffett. He may not be the best trader out there, but he puts the odds in his favor, and he does not gamble. As promised, I went ahead here and I pulled up my trading journal. Like I said, record everything. You're not going to learn unless you record things. Just like in school, you have to take notes in order to learn. Same thing here. If you're in college and you're doing well in college, that means you know how to learn. You know how to teach yourself, and you know how to acquire new skills and whatnot. So trading is no different. You need to put a time and effort into everything. For example, here I have a trade history. I record every trade. While it is time consuming, I still do it, even if it's not a good trade. Like here, I closed this trade out with pretty much a break even. But I'm going to come back and I'm going to remember what I learned. For example, here's a great trade that I was in. Then I later had to get out of this trade. I took gains, got back into the trade, and then I had to get back out of the trade, and I document that whole process. Here is a trade I got in. I did a quick 6-7% on. I was really happy at the time, but then this thing ran 40% after I had sold it. So here's an opportunity for me to record my emotions, record what I was thinking at the time, and kind of learn from my mistakes. When I have chats with my mentor, I come in here and I try to log this kind of stuff that we're doing. We do Skype sessions every now and then, so I'll come in here and I'll log things. And then when I watch YouTube videos that I really like, I might take notes on it and whatnot. When I really struggle with something, I may record it in here as well. I talked about earlier how you should record things that you have opinions on, even if you don't take a position. Here I'm recording, this is something I recently started doing. As you can tell, I only have 2 entries. I've been recording charts that I have an opinion on, but am not willing to take a entry on. And so I'll come back, maybe a week, 2 weeks, 3 weeks, a month later, see how they did. I don't really have much in here, mainly because I do it on paper and keep it in my trading binder, 3-ring binder that I have. But I always think it's good to record quotes and whatnot that you think of people. Here I have, sorry, that's not what I wanted to show you. Here I have a resource list. I use, anytime I find a new resource that I like, I might record it in here. So these are the kind of things that good traders do. That make them successful, and just like school, you need to try to make yourself as put the odds on your side, and record things so that you can learn better and progress faster. It takes time, it takes practice, it takes effort. So what you're expected to know up to this point: how to draw support and resistance lines, how to draw channels, how to draw trend lines. Remember 3 points of contact. On upward trend lines, we connect the lows. On downward trend lines, we connect the highs. A chart pattern or two, such as wedges and flat top breakouts. I've gone ahead and actually pulled this up for you here. This is an example of some chart patterns out there. The majority of these I don't really use, but there are a few that I do use. For example, a triangle breakout, a wedge breakout would be something like this. Here's a flat top breakout with a wedge type formation. They call it an ascending triangle. People use names interchangeably a lot. I showed you an example just a couple slides ago of a trade like this. Some people use head and shoulders patterns. Here is an example of a channel that breaks to the downside. Those are some chart patterns that you might know, are expected to know up to this point. You also expected to know how people might try and use moving averages. Well, I don't use moving averages too much. A lot of really good traders do. I know a multimillionaire that uses moving averages when he's day trading, things like that. So people do use them. Log scaling versus arithmetic scaling. You should know the difference, right? Log scaling is when the y-axis is in a logarithmic format. Arithmetic is when it is not in a logarithmic format. You're not expected to know how to use these things yet to make the trade decisions on them, but I do expect you to know what they are, how to draw them, and how to identify some of these things. Here's a quick example. Okay, so we just discussed support and resistance. This is something that just this past month it came back. It tested this clear support line. It formed a doji candle pattern, and that would be this candle right here, and then it moved higher. We'll discuss candle patterns in upcoming sessions, but notice how we came back down. We had a reasonable certainty because it's already tested this same point, this same trend line / resistance 3 times already. We have reasonable certainty that it might bounce again. And then so we might look for candle patterns to confirm that it has a high probability to bounce. So I might get into a position right here, put a stop loss right below the low of this candle right here, the last bounce point, with the expectation that it moves higher. If it moves lower, I get stopped out, no big deal, right? If it moves higher, great. I'm so glad that I was right. Here's another one. We have a wedge type formation. This is an ascending triangle. We have resistance. We seem to have a form of a trend line here that's acting as support. Notice that we break out of this resistance right here and we move higher. Notice that it then actually comes back down and tests that old resistance line, and that old resistance actually acts as new support, and we move higher. Here we go again, same setup as before. We break out, we move higher, we retest, and then we move higher. Some of you may say, now Brandon, this doesn't actually look like a resistance line because this point of contact isn't perfectly touching, and we kind of break above it right here as well. And remember, resistance is not always an exact price, but rather it is a area, a range. 1%, 2%, it's not an exact number. So let's start to go ahead and discuss some new material here. Before we do that, or before we get into the MACD indicator, I want to go over some quotes that I want you guys never to forget. These are things that I always keep in the back of my mind. Remember, we talked earlier about not gambling. Those of you that are gambling, you're going to lose big one day. And always remember, your next biggest loss is one trade away. I try to always assume that I'm wrong when I get into a trade. Why? Because I'm less likely to take trades. I'm more likely to second guess myself and really ensure that I'm making a good decision with my money. Another one is an opinion does not mean a position. I stressed this earlier. That's why if I have an opinion about things, I may record the chart, put it in my OneNote, come back a few weeks later, see how it did. A reality of being a trader is you never have enough size when you're right. And you always have too much size when you're wrong, right? Think about how many times in the past you've been in a 15, 20, 30% trade and you're like, man, I didn't have enough size in this. But then when you have a 10% loss, you're like, man, I had way too much size in that. What was I doing, right? So that's a reality of being a trader. That's why position sizing is so important. It's you have to be consistent with what you're doing. You're not gambling. Never go all in. This is not poker, right? This is real money. This is one bad trade where you go all in can literally take everything from you. So don't get greedy. Be humble on the big winners that you have, and when you're wrong, you're wrong. And another one, I tell new traders this all the time. They're like, Brandon, well, I'm not going to even bother with the stock market because I don't have any money. And it's like, well, if you can't make money with a little bit of money, how are you going to make money with a lot of money? You're not. You're just going to lose a lot of money if you lose a little bit of money, right? So these are some things to keep in mind. These are some of my favorite quotes, and I wanted to share them with you guys. 90% of people don't know what they are talking about, so when you find somebody that does, listen to them, and always be careful with who you listen to. When you get on StockTwits, that shit is toxic. Let me tell you, StockTwits is toxic. 99% of people on StockTwits don't know what they're talking about. When you get into these chat rooms, be very careful with who you listen to. 99% of them don't know what they're talking about. And not to down anybody here, but you got to be your own trader. You got to have your own trader identity, and you got to make your own decisions. When a friend or a family member is recommending a trade to you, I stress you not to listen to them. And why is that? Again, because 90% of people don't know what they're talking about, right? 90% of people don't know what they're talking about. So just keep this stuff in mind. Be careful who you listen to. I also recommend that you don't give stock picks to friends and family. Why? Because that can kind of destroy your social life. This is just some few things that I wanted to talk about with you guys. Lastly, stop losing money. Quit trying to trade penny stocks if you're a new trader. Yes, you can make money in them, but majority of you, if you're watching this video right now, most likely you are not trained. You don't know what you're doing. Don't try to trade penny stocks. You're gonna lose. You'll lose everything. I promise you, if you're new, you will lose everything. Young investors, they're still around today, are around because they never tried trading penny stocks. I made 35% returns my first year trading reputable companies. 35% is a lot of money, right? I think that's a good return. I know multimillionaires today that do trade penny stocks, but they're trading penny stocks because they have, 10,000 hours in front of the screen, right? They've been there, they've done that, they've studied hard. They don't just talk the talk, they walk the walk, right? So if you're new, I just stress you not to buy anything that does not have positive earnings per share. That will just kind of prevent you from buying a shitty company. Also, don't buy anything below $12, just a general rule of thumb. Go ahead and listen to me now on these kind of things. You'll most likely thank me later. Quit losing money and focus on learning. If this is your first year with stocks, stop trying to make money. You're not going to make money. And if you do, great. I'm glad for you. But you're going to be humbled very quickly once you start to think you know everything. The very first time I lost money, I didn't trade for 3 months. I made 35% my very first year in trading. I lost all that money in one trade. So I literally lost almost $1,300 in one trade. I got greedy, and I thought I knew what I was doing, and I got humbled really quickly. And I didn't trade for 3 months, and it was probably one of the best decisions I've ever made because I came back better than ever. When I came back that very first week, I placed 5 trades. I nailed all 5 trades, 10 to 15 to 20% on each one. Learn now. Money will come later, especially if you're young. If you're trading with $5,000, that $5,000 is nothing. Once you get a real job in life, $5,000 means nothing at all. Trust me. So quit losing money. Quit trying to make money now. Focus on learning. Money will come later in your life, especially if you're young. If you're getting into trading and you have a full-time job and whatnot, this is even more important. If you have a family, you don't want to be losing your money trying to be Trader McGee, trying to be, some day trader. Focus on learning. The money will come later. You got to have patience. Lastly, let's talk about position sizing. Risk is a real thing. People lose entire accounts. I've seen it over and over. Don't trade with money you can't afford to lose. If you just bought a house and you don't really have much spare cash, that's a great example of don't trade with money you can't afford to lose. If you just bought a house and you only have a couple thousand, in equity or cash left to your name, don't try trading with that money, because what happens if you make a wrong trade and you lose it all, right? That I've seen it before, and when it happens to people, it can really ruin people's lives. Don't trade with money you can't afford to lose. I also really recommend people never to have more than 25% of their account in a single equity. Just don't do it. Proper position sizing is very important. So I have an $8,000 account. I'm 22. I have an $8,000 account. My general position sizing is anywhere from $1,000 to $2,000, which is a little bit high. But again, I am trading with only an $8,000 account. I have a lot more money in the bank. So $1,000 to $2,000 is really the minimum. I'd say $1,000 is the minimum you should have in most of your trades. Anything less, you're never going to make anything. With $1,100 and an 8% return, you can make about $100. So just keep that in size. Reduce size when you're losing. If you've had a few trades in a row where you're losing, reduce your size. When you have won, a couple trades in a row, maybe consider increasing your size when you're winning. Risk is real. Like I just said, risk is real. Notice here, this is I know, grown men that were in this thing, and they literally lost 30%. Overnight, this thing dropped massive. They had a phase 3 drug failure that they announced here, and it massive drop. Then they had earnings, and they discussed that a little bit more. Massive drop. I know people that bought here thinking, I'm going to make huge money when they talk about it at earnings or whatnot. They're going to release some bullish guidance, and what do you know? They gambled on earnings, and they lost, over 15% in a day. Risk is real. Don't think that you're smarter than everybody else, Manage your money. Position sizing is huge. So stop losing money. Seek to be educated before seeking to be rich. Okay, let's start talking about indicators here. I'm way over time as far as what I thought this would take. We're 33 minutes in, so apologies on that. Hopefully you did put this on a little fast-forwarded speed on YouTube. For example, here, this is something I sent to my dad, and I told him it was going to bounce right here. Sure enough, it did, and now this thing's all the way up above 170. The next day it bounced. How did I know how to do that? It's because I know how to use indicators. I told him one of two things. I said it's either going to bounce, and you can kind of see there's a doji candle right there, which shows indecision, which shows things, it could be a turning point. But I kind of want to teach you how do I use these indicators. Today we're going to be talking about MACD specifically. Number one thing, when you're trying to learn technical analysis, ask yourself this question. Where was the last rally? How could I have gotten into that last rally, right? I'm going to be looking at a chart like, let's say, NVIDIA or Apple, things that have been running massive, right? Okay, when was the start of the last rally? Where were my buy signals? That's the best thing you can do when you're trying to learn technical analysis. Okay, so today we're going to be learning MACD. MACD stands for Moving Average Convergence and Divergence. I highly stress that you do not use traditional wisdom when you are trying to learn MACD. Conventional wisdom is to actually buy when the two moving averages cross. So you buy here, you buy there, and notice it would be a terrible buy. You're not making any money whatsoever for the most part. You can make money buying whenever they cross. Like here, you probably would have made some money. But for the most part, you don't have the best odds when you just willy-nilly buy whenever they cross. So that is why I really stress not to use the traditional wisdom of how to use MACD. So we have our own way of interpreting it, and I'm going to teach you that today. Again, please don't use the traditional method. It really does not work. One thing I really like to remind people of is only idiots hope for things. Don't hope for signals. We look for these signals. Real traders look for signals. They don't hope for them. Another fun fact for you, MACD indicator is considered to be a lagging indicator, meaning it lags price action. Okay, so how are we going to use MACD today? There's a few things. What I just showed you, the traditional wisdom, is called a signal cross, right? When the blue line crosses the orange line, that would be considered a signal cross. The blue line is the 26 period exponential moving average. The orange line is the the blue line is the 12 exponential. 26 is the 26 exponential moving average. So that would be considered a signal cross. My favorite is to look for zero line crossings. That's when the MACD, you can see down here we have a y-axis scale. If we cross this zero line right here, that's what I really am looking for most of the time. We also can use trend lines. We literally can connect trend lines on the MACD. And we're also looking for histogram divergence, and we'll talk all about this in the coming moments. So the more signals, the more of these things that come together all at the same time, the better. We just have better odds when that happens. Okay, so the traditional setting, when you add them to most charts, you're gonna have the 12, 26, and 9 period. I also occasionally use the 5, 8, and 3, and I generally, if I use the alternative setting, I use them together. Okay, so a signal, let's just get our terms correct here. When I say there's a signal crossing, that means it's the moving averages are crossing. So this would be a signal crossing right here. When I say uniform action, that means there's a symmetrical swing of the MACD. Let's see if we can't find you an example here. This would be an example of symmetrical price action. Notice right here how we come up, we cross the zero line, and we come right back down. This side is pretty much equal to that side. I would call that uniform action. We'll discuss that later. Earlier I had said that we ignore the traditional wisdom and we ignore most signal crosses. Why is that? Why did I say that? Notice here we have a signal cross with no sustained movement. Notice here we have a signal cross with really no sustained movement. Same thing here, same thing here. And then on this one right here, we do actually get a significant move. How can we actually determine what will be a significant move and what won't be? That's what we're discussing today, but this is kind of why I was stressing not to use the traditional wisdom. It does work at times, and other times it really doesn't work. For example, here is a signal cross that occurs way below the zero line that has no sustained move to it at all. Same thing here and here. Now this one actually does have a sustained move to it. So, clearly there's a bunch of false signals in here, and if you just blindly follow these crosses, you're not going to make money. You're going to lose a lot of money, especially if we're in a range-bound market. So remember this, signals near the zero line do carry more weight. The further away they are, the weaker they are. Zero crossings are my favorite. That is where the money is at. We are always looking for a zero crossing. We'll discuss that more in a minute. Now, you can draw, earlier we discussed trend lines. You can also draw trend lines on MACD. Trend line breaks in conjunction with another signal, such as a zero crossing, carry a lot of weight. If I'm losing you here with the context, just stay with me, come back to this slide in a few moments, and you'll see exactly what I'm talking about. And also be aware of uniform action rejection, right? We said uniform action is when we have symmetrical action, where we come up, come down, and it looks symmetrical, right? Both sides are equal. So beware of uniform action rejection. Okay, MACD zero crossing. This is what a MACD zero crossing is. MACD zero crossing, by definition, would be this right here. We also would consider this relatively zero crossing. This one right here I would actually describe it as uniform action at the zero line. We come back down, we sweep that zero line, and then we take off. I would love to get in or add to my position at this point of contact right here. So a zero crossing, the easiest way to look at it would be this right here. If we break the zero line, I love to get in right here. And when we have uniform action and we retest that zero line and then we come back off it, I love to get in there as well. This is primarily what we're looking at for MACDs. So if you don't learn anything else about MACD today, zero crossing. It's very easy to search for, and screen it as well. So search for zero crossings. Okay, here's a great example for you guys. This one moved massive. This one moved from 38 all the way up to 50. I'll take that trade any day of the week. Notice I got in down here. Notice we have a perfect zero crossing occurring right here. Now notice if we look back a little bit of ways, we can also see that we had uniform action rejection right here, right? We come up, we sweep that zero line, and then we get pushed to the downside. Now, you may say, now wait a minute, Brandon. This portion of the, is not the same as this portion, and that's fine. The idea is the angle of sweeping is what we're really looking for, right? We're really looking for, some sort of arc. That would be defined as uniform action, right? We can even come over here, and let's look. Here we sweep down to the zero line. We had uniform action. We sweep down, sweep back up at that zero line right there. Bam! Look at this explosive move afterwards. Same thing here. We come down, and we're seeing a sell-off here. I'm trying to get in for the next rally in this stock. Bam! We get a zero crossing. I enter right in here. That's massive money. That's massive money right there, and I move higher. We come back down, I test it right here, get back in, and I get back in again over here. You can also use zero crossings as sell signals. I would have sold right here, right? If you got in here, you might have sold up here when it crossed zero again. You're still making gains. So this is what we're looking for, right? Okay, what about this one? This one moved massive from 92 to 131. Man, that's money right there. Notice that we have this perfect zero crossing right here. Notice we also have this trend line break as well, right? We have a point of contact, and we have lots of surface area here that acts as another multiple points of contact. You might say, now hang on, Brandon, is this really a trend line? Yes, it's a trend line. Why is it? Because we come up, we form another point of contact right here, and we have massive surface area right here. With MACD, things aren't as pretty as, the candles may be, right? You can definitely clearly tell that we have several points of contact right here. MACD, you tend to get a little bit of surface area points of contact at times that still acts as a trend line. And look, we get a trend line break along with a zero crossing, along with a signal crossing as well, right? We said earlier when the two lines cross, it's a signal cross. So we have like three things occurring right here. And so we're stacking up our odds here, right? MACD has a very powerful signal going on right here. And we also have a wedge formation right here. A wedge formation, so we break out of the wedge. That would be a buy signal. When we break out of the previous resistance right here, that would be another buy signal. So we're trying to really stack our odds here. So quick 15-second explanation. Where were our buy signals right here? I would say when we finally break out of this trend line, when we saw a zero crossing that had a sustained move, right? We were trying to break out it up in here, but we didn't. But here we finally broke out, had a sustained move. At the same time, we also broke out of this wedge. We later got rejected by the previous resistance, but then we broke out of the resistance right here. And when we broke out of this resistance right here, we moved higher. Okay, another one here. So here we have a zero crossing occurring, and we move higher. Now, notice I said this was resistance right here. Why did I say that this was resistance? Because the last time that we tried to move higher was right here. The MACD got rejected at this point of contact right here, right? So not only do we have, a resistance line on the candlestick patterns, I would also say, hey, last time we tried to move higher, MACD got rejected at this point, so I may draw a resistance line right here. This may not be as intuitive for some of you new guys, but it kind of makes sense, right? We try to move higher right here. We try to break past our all-time high back here, but we were unable to. So if I see a zero line crossing, I'm next looking for a resistance break on the MACD line, and then when that happens, we go. So I didn't really talk much about resistance lines earlier, but it makes sense, right? We try to move higher. We couldn't move higher. MACD tried to move higher, couldn't move higher. I'm going to draw a resistance line there, see how we interact with that line in the future. And when we do finally break past it, which clearly we did, we moved 12% here. That's a good entry point. So some of you may be looking at this and you may say, hey, Brandon, this is only 2 points of contact. And some of you also may be like, wait, no, this is 3 points of contact. I don't think that you could call this 3 points of contact because when you drew this line, you would have been saying that this candle right here was your third point of contact, when in fact it really never stalled around this trend line. Sure, it did close at that trend line, but it never really, it never really came up and then came back down and then broke out, right? So I would say you would have your 1 point of contact, your second point of contact, but you really don't have a third point of contact right here. But I would still call this a preliminary trend line. If I did see a break above this, I would love to get into it. Okay, another great example for you guys. We have, again, another zero line crossing with explosive moves. Well, I guess it's not that explosive because we only move up from like 164 from 155. But this is on a blue chip stock like Home Depot, something that you would be proud in telling your dad that you bought. Notice how I didn't draw this a second ago, but notice how we tried to move higher right here. We couldn't move higher right here, and then we actually did break out. So we broke out of the resistance that formed right here. Why is it resistance? Because we tried to move higher right here. We failed to move higher. We also tried to move higher right here. Look, oh, wait a minute, those two lines coincide with each other. This is clearly some sort of resistance. We have a zero crossing, we break that resistance, and then we get in, right? And then we get we really put the odds in our favor. Okay, another great example for you guys. Here we have a zero crossing right here, and we get in. And we also have a chart formation right here of a trend line break, and we get in and we get a nice little run up. Now you'll see that I didn't draw this on the chart originally, but we actually have a resistance line right there, right? We tried to move higher on the price action right here. We got rejected. So did the MACD at this point right here. So I'd say this might be resistance. Same thing here. We tried to move higher here. We tried to move higher than the all-time high, but we got rejected. Wait a minute, they both line up at the exact same point in contact. Now that's something. So if this on this third retest, if we can actually break out, we might actually have a sustained move here. So we have a zero line crossing that then transforms into a break of resistance on the MACD along with a price action breakout. The odds are really in our favor here, right? It's all about stacking our odds up. Also notice that we have nice volume on our breakout right here, right? This volume is rising. It's above the 10-period moving average on the breakout right here. So we have relative certainty that this is moving higher. I had said that there was 4 buy signals here, the RSI, the volume, the price action, and the MACD. I advised caution because I'd caught this on these bars in here, and I'd said that these bars they have big wicks, so they're kind of showing some slowing of momentum. But nonetheless, this thing did finally move higher. And notice when it did finally move higher, we broke this all-time high right here. That's kind of where it stalled out. It's kind of stalled out at this all-time high right here, right? Kind of stalled out right here, and then we did move higher. But that zero crossing is what we're looking for. Okay, here's another one. This is on a much smaller time frame. Notice here we tried to move higher here. We tried to break above this resistance. We're on the 1 hour right here. We tried to break above this resistance. We could not break above that resistance, and so I would say, hey, that's resistance right there. And then we did break above that resistance. So this is just an example of a resistance break on the MACD. Okay, here's another one. So we have a trend line break down here, where later followed up with a zero crossing. When we have this zero crossing, we also break minor resistance right here, and we move higher. This one may be not as intuitive for the newer traders out there, but we have a few things kind of lining up here. You could have had a first entry at the trend line break, a second entry at the zero crossing right here. Okay, this one had massive moves. I actually made a YouTube video about this one. Let's go ahead and analyze it some. So you see that we have a zero crossing right there. When we have this zero crossing is down here. You may have waited to get into this for whatever reason, so be it. But once we broke this clear resistance right here, you may have gotten in right here, right? And then we move higher. You can also see that we have some sort of trend line kind of developing right there. It's a little loose. There's really only 2 points of contact right there, but so be it. That's why I didn't originally include it in the original idea. Here's another great example for us. We have a trend line break down here, right? Trend line break, and then you can kind of barely see that we have we're right at that blue line right there. We're right at that zero crossing, and you can see once we cross that zero crossing, we move higher, and this thing runs. That's a 30% move right there. So this thing really runs higher. Again, so we have a trend line break that's then followed by a zero crossing. We have the odds in our favor. And if we look back even a little bit further, look, the last time this same thing happened, when we had a trend line break and a zero crossing, we moved higher. And let's review that thing about uniform action and rejection. See right here, we kind of tried to move higher. We got rejected at the zero line, came back down, and there's 2 humps there. So be it. You might say it's not uniform action. I say it's close enough. And we did not move higher, and that was up in this region right here. But the next time we tested that zero line, we did move higher, and we also broke the trend line in the process. Okay, here's another example of resistance break. I've already covered this example. I don't know why it's in here. Okay, let's look at this one. So here we're actually combining 2 separate MACD settings. Remember, when we first started discussing MACD, I discussed that there's 2 different settings that we may choose to use. the default setting and this alternative setting based off of Fibonacci numbers. Now, remember, we're always looking for zero crossings, and we're also looking for signal crosses that occur near the zero line. Near the zero line. Quick point that I didn't really mention earlier was when you have zero crossings, if you're, let's say you miss a breakout level and you're trying to get into a trade, it's okay to go ahead and try to enter a trade late when you have another signal crossing on the MACD. I'm not going to talk about that too much because I don't want to lose too many people, but just keep that in mind. If you know anything about technical analysis, keep that in mind when you're looking at it next. Notice here on the lower time frame setting, we had a trend line break followed by a MACD crossing. At the same time, we had a signal crossing that was pretty close to the zero line. So we have this MACD saying to buy and this MACD saying to buy. Here we have the exact same thing. We have a trend line break followed by a zero crossing. And this one also has a signal crossing that's pretty close to the zero line. Here we have a break of a trend line. Break of a trend line followed by a crossing, signal crossing right here. I haven't really talked about that much, but you have a break of a trend line. We move lower. You may, it's a harder signal to find, but it's there. Okay, here, what do we have? We have a zero crossing. At the same time, we also have a delayed signal crossing over here. If you match the zero crossing up with this signal, this crossing signal right here, you have two things stacking up. At the same time, we also have a price action break. You see how we have multiple things coming together. Price action, we have a downtrend breakout on the price action. We have a zero crossing in the lower time frame, and we also have a signal crossing on the higher time frame of MACD. So we have multiple things stacking up here. I told you to ignore these signal crossings that are below the zero line for the most part. You could still say it's a signal because all these other things are kind of stacking up. What else do we have? We have a zero crossing to the upside along with this zero crossing right here. That's a good run. That's a pretty good run up. Here we have a trend line break followed by a zero crossing. This doesn't really give that much of a good signal, but you see what I'm doing here. I'm using both of these to kind of give us signals here. I had said that this was a sell signal right here. Potentially not. It depends if you're a momentum trader, you might use this, and we are on the monthly here. You might have said, hey, we have a trend line break here, and there's a bit of surface contact area right here, meaning this is a valid trend line. We have a break of that trend line. I'm going to get out right here, and you would have, could have gotten back in over here when we have another break of a trend line. So this is kind of combining a lot of stuff. I hope I didn't lose too many people in this example right here. I hope you guys enjoyed this one. So remember this, if anything. What I expect you to remember really is we want zero crossings. That's what we love. We love zero crossings. Remember to draw trend lines. A lot of people forget to draw trend lines. Trend lines are your friend. When you see a trend line break along with a zero crossing, that's money. Listen to that signal. Again, going back to the zero crossings and scanners, you can use scanners to find you zero crossings. Don't take all zero crossings. Not all zero crossings are created equally, but it's very easy to search for. Yeah, remember, when we're drawing trend lines, look for multiple things to occur at the same time. Do not use MACD by itself. You got to use price action patterns like trend line breakouts, things like that. If you're going to use MACD by itself, I do recommend using both of the default setting and the alternative setting. Use your head. Don't be a blind trader. Don't just follow any zero crossing you see. It's all about putting the odds on your side, but in order to put the odds in your favor, you have to use your head. And if you do not know, watch on the sideline. An opinion does not mean a position, and if you don't take a position in something, go ahead and record it. Record in that trading journal that we talked about today. Next time, we're going to go ahead and discuss RSI. It is my fan favorite, but as for right now, I'm going to go ahead and close this presentation up. I hope that you guys like this. Remember what I said, some of those quotes that I gave today. If you did like this video, go ahead and leave a like in the go ahead and like this video, subscribe for more, and let me know if you have any comments.